Great.
It is on, yeah.
It's looking good?
Yeah.
Okay, we're so excited to have Praneet here with us today. He's one of the founding partners at Rosten Capital, focused on bringing Indian companies into the American market. He's going to be talking to us today about SPAC, IPO, and the stock market. Where are we headed? So please welcome Praneet.
Thank you. My name is Praneet. I'll go ahead and introduce a little bit about myself and then Rosten Capital, and then we'll dive into the main talk for today. So I'm born and brought up in India. I moved here 2017 for college mainly, UC Irvine. I attended UCI, studied computer science, but all throughout my life I've been very entrepreneurial, I would say. Back in middle school, I built an app that I ended up selling to Nokia. So that was kind of the beginning of my entrepreneurial journey, I would say. Did some stuff in high school, came to college, CS, computer science. And then during college, I kind of realized that I have more inclination towards finance. And at the same time during college, I met David. He's right there, David Rosten, and we kind of kept in touch. And then towards my senior year, we were like, "Hey, let's start a fund that focuses on new and niche things that not a lot of bigger funds would be focused on, essentially." So some of the markets that we picked were the SPAC market. Well, SPAC was kind of like very popular over the last couple of years, and sure, there were a lot of SPACs coming out. A lot of terrible SPACs were coming out, to be honest. But our focus was more on investing in those SPAC, or not just investing per se. We are long and short both. So if there are SPACs that are overvalued, and majority of them are overvalued, we will short them. If there's a good one coming out, we do go long on them. So that's the kind of stuff we did. We are now also focused on bringing Indian companies to America, and primarily because, well, I'm from India. I speak Hindi. I know the culture over there. And I've noticed that not a lot of Indian companies are coming to America. Like, they just kind of stay in India. They don't really think about raising money from America. A lot of Chinese companies do come to America. There's Alibaba. There's a whole bunch of them. There's Tencent. There's Trip.com, all these companies from China, but not so many from India. So early this year, we kind of switched gears and we were like, okay, let's focus on bringing Indian companies to America. So that's where we are working, and I've been talking to a bunch of medium to large corporations. Their revenue ranges from 100 million all the way to 5.6 billion. That's the largest one I have. These companies want to list here, and we're kind of helping them in the process. So that's where we are right now. But that's the whole overview of me, the Rosten Capital. But now let's kind of talk more about SPACs, IPO, and what's kind of essentially going on with the market. Is it Zoom? Okay, sure. Let's see. Share screen. It will be, which one would it be? That one? Oh yeah, that one. Okay.
Thank you.
Okay, so I'm sure. So what SPACs are? Let's talk about that. So when a company gets too large, or let's say they have $50, $60 million revenue, there will be a point where they want to raise more money, and one of the ways they do it is by selling equity. So the routes they have is they can either do a traditional IPO, or they can go merge with a SPAC, or they can also direct list, but although direct listing is not that famous, there's hardly any companies there. Coinbase did it, but it kind of does not always work out good. But anyways, mainly there are two ways: traditional IPO or SPACs. SPACs are basically publicly traded vehicle, and they have money inside them, and SPAC is run by some managers, and their job is to go find a private company and merge with that private company in 2 years, or And if they don't do it in 2 years, the SPAC kind of just gets delisted. They lose the money and yada, yada. So the founders of these SPACs are really incentivized to go finish a deal, merge with any kind of company, put whatever kind of valuation. And when that happens, we get a graph that kind of looks something like this. We used to have close to about 30, 20 SPACs. SPACs were invented back in 1993. This guy, David Nussbaum, he was one of the main founders for these SPAC, and we had a normal number, but coming to 2020 and 21, there's too much money available in the economy. We have guys like Chamath who really promoted these SPACs, and SPAC frenzies pretty much started happening, as Wall Street Journal said. And we have like 600 SPACs out there that are all looking for targets, aka private company to take public. And you don't have that many private companies to begin with. And even if you have that many private companies, they may not want to go public, or they might not be a quality private company. So when stuff like that happens, you end up with SPACs that are merging with companies like the metals company, top of my head. Their ticker is TMC. They kind of like promise that they'll find some kind of mine in Africa. But anyway, they got listed at 2 billion something valuation. And right now the stock's down like 90%. They're trading at like 70, 80 cents. That's one example. Then there's Weed Maps would be another example, got listed at 1.8 billion valuation. And that obviously is a very high valuation for a company that has revenue, I believe, 200, 300 million, something like that. And obviously the stock's down, it's trading at $1 something cents. So that's what happens when you have too many SPACs looking for some company. So what SPAC founders do is they kind of say, oh, we'll put a higher valuation on your business. Sure, we can put a higher valuation, but the problem is, will the market accept that valuation or not? Most likely they don't. So in 2022, this year, so far year to date, 11 months in, we only have about 83 SPACs out there. So you can see the number has fallen, and I kind of made that edit instead of like making the whole new graph. But the number of SPACs have fallen, and they should fall because we don't have 600 quality private companies to take public. Maybe 20 per year is more ideal, as it used to be back until 2019 pretty much. Another thing is, when I mentioned that a SPAC has to find a private company in 2 years, and if they don't, they have to get liquidated, they return the money to investors. The main SPAC managers, they're the ones who lose money. So now it's kind of starting to happen because SPACs that were created in 2020 or 21, they're now starting to get liquidated because they do not have a good target. And you can kind of see this light blue thing that you see. This is kind of showing that how many SPACs have liquidated. Liquidated meaning they are not listed on the market anymore. They return the money to their investors. And this is specifically for this year itself. We can see the number of SPACs that are coming out, which is shown in green line. It's going down month by month, and November only saw one SPAC that actually came out. And instead, the liquidation rates are going up. So all in all, the thing is, no more new SPACs should be coming out that are focused exclusively on America and are exclusively trying to find a good unicorn kind of company in America, because there are not that many. And even if there are, they maybe don't want to go public right now. And with the entire market uncertainty, like a private company just maybe don't want to do it right now. So what we did is, one thing that we changed is we're not looking in America for a private company. Instead, our focus is more of Indian companies. And so one of the things we do is we invest in SPACs, as I mentioned, invest like on the secondary market, on the stock market, we buy or sell their shares. And one thing I noticed is a lot of these SPACs are run by American people, which should, like, sure, they're run by American people, but the downside of that is they don't have the reach or they don't have the cultural experience or knowledge to be going out of their way and trying to find a company that is based out of India. India, it's an emerging great economy. We have companies that are super big, but they are just not being approached. And I'm not just saying it out of thin air. I actually talked to a bunch of these founders who are large $1 billion revenue companies, and they haven't been approached by any of these larger banks to list in America, or even if they were approached, they're kind of scared that it's some American guy trying to bring this Indian company. So there's a cultural gap. There's the trust factor is kind of lacking. So what we focused on instead is me, who's Indian, I can speak Hindi. I went to India, tried finding a bunch of these companies with the help of my parents, to be honest. They were kind of helpful in that. So they kind of connected me to some people, and I talked to them, and they're super down to be listed in the American markets. And so now we're just essentially working on bringing them here, and we don't want to be another SPAC that has that liquidates or anything, just because we're exclusively focused on the Indian market, and India has a bunch of those companies. Just to give you an idea of how the SPAC market was kind of taking over, but I don't think so anymore, so this is a graph that shows the percentage of SPACs versus traditional IPOs, the number of companies choosing SPAC and traditional IPO. 2016, it was a low number, about 10-something%. Coming to 21, more than half the companies, or even 2020, more than half the companies were choosing SPAC, just because it was easy to go public with a SPAC. But as a lot of them found out, that just because it's easy to go public with a SPAC doesn't necessarily mean you'll hold your share price. And in most of them, the share price fell. There's hardly a handful of SPACs that are trading above $10, which is their initial price. Anyway, so a lot of them fell, and now again, 2022, most of them are going back to traditional IPO. It's just the markets, they're difficult right now. So with that, all of that being said, let me see how much time I have. Okay, 9 more minutes. Okay, so quickly wrapping some of these things up and kind of going into the whole economy and the stock market stuff. We're at a juncture where the government's printing too much money, and when there's too much money, then stuff like SPAC happen, and a lot of bad companies go public with these SPAC, but now the interest rates are rising. So I'm not trying to predict where the stock market's going to go. No one can really predict that. No one has that 8 ball and can say, oh, the stock's going to fall tomorrow or something's going to happen, that or this. I don't know where it's going to go essentially, but the Feds are raising the interest rates, and for December, I believe they're aiming more at 50 bips. So let's see. I personally, for our fund, we are more focused on the SPACs. SPACs don't tend to be related too much to the major economic factors. They're rather more focused on how the company is, what kind of valuation there is. If you take a 10 million revenue company and put a $1 billion valuation, these stocks obviously going to fall. Definitely stocks going to fall. But let's say you take a 200 million revenue company, you put valuation that is in line with the valuation of competitive peers, maybe put some little discount, you put it on market at 250 million, that could be perhaps a good buy, who knows? Depends on a lot of factors, but that is still a good point. But again, if you put them at billion or 2 billion valuation, that's starting off with a good, that's not a good starting point. So those are some of the main things. And at the end of the day, I feel like when my friends or someone would ask me, oh, where should I put money? I kind of just tell them, invest your money in S&P 500. This is not a financial advice or anything, but I'm just saying from my experience, and I agree a lot of you here would have a lot more experience than me, but what I've seen in a few years of my experience is that if you just invest in SP 500, you'll be much better off than giving your money to any investment advisor or any fund advisor or anything per se. Obviously, a lot of things come down to your risk tolerance, what kind of risk you want to take, but for the majority, for 99% of the people out there, like if you just put your money in SP 500, compound that for another 10, 20, 30 years, you'll probably have performed better than most of the hedge funds out there. And there are a lot of hedge funds and you can't really be picking which one's going to win, which one's not going to perform good. You don't necessarily know that. So just put your money in SP 500, economy is going to do fine. Questions like, are we in a recession right now? It's a difficult one to answer because we don't know. Like, things are doing fine. I think this morning I got one of those notifications from Wall Street Journal saying the labor market is doing absolutely fine. The unemployment rate is at 3-something%, like stuff like that. Like, things do seem to be doing just fine. So things will be fine. And that's why just invest in SP 500. You'll be better off than picking individually stocks or trying to do tens or hundreds of hours of research. So basically SP 500. Okay, that's pretty much it, I think. Little short talk. But yeah, if there are any questions or anything that I can answer, I would be more than happy to do so. Yeah.
Okay. Jeremy, I'm not sure if this one's live.
It is.
It is?
It is.
Excellent. Okay, I'm going to hand this off to you. Thank you
Okay.
for speaking with us. We're going to keep you up here. We're going to do some Q&A. John is going to go around and get some questions for us. Thanks, John.
Thank you, Christina. Thank you very much, Praneet, for giving that presentation about stacks, because as you said, the past couple of years, there was a lot more, it was in the headlines a lot more often. And I think a lot of people are confused as far as, well, what is stack, and which is an acronym for Special Purpose Acquisition Company.
Yeah.
And its sole purpose is to go out there and find businesses to buy. And so anyways, I'm glad that we were able to get some insight from you on what your thoughts are as far as the SPAC market is concerned. And before I start asking questions, I just want to give our attendees a chance to maybe ask the question.
Hi, first of all, thank you so much for coming in and presenting a very interesting presentation. I've been loosely following SPACs since they got in the headlines over the past couple of years. Spent about 20 years myself in the investment analytics space and wasn't really interested in them until they started getting more publicity. This year, as you noted, it's been a huge decline in the number of SPACs out there. A couple of weeks ago, I think Grindr did a SPAC merger.
Yeah.
What was really interesting about it to me was on the first day of trading, the stock pumped like insane from $20 to like $70, something like that. And it was reported that because the liquidity of stock was so low, there was just not enough stock available.
Yeah.
So subsequently, I learned that there's a redemption process, meaning that the people in the SPAC can redeem their shares in the SPAC. And I think it was something like 98% of the investors redeemed, leaving a very, very small number of shares available for trading, which led to this huge pump. From 70, it's now like maybe $7.
Yeah.
So it's down like 90%. So it just seems really ridiculous the way some of these things trade, and highly speculative, highly risky. Yeah. And I'm just curious if you can comment on this redemption process. Yeah. And do all stocks have this ability to redeem? And is it unlimited? So if 98% redeemed, then there's no money left for the company, in this case, Grindr, to use. So the purpose of raising money is now gone. They're not really going to get much money. Yeah. So can you comment about that?
Yeah, certainly. Grindr was an interesting case, and there have been pretty much every merger that is going through this year is having the same issue, that the redemption rates are high. What redemption means is that when you buy shares of a SPAC on the secondary, on the stock market, you buy it for something like $10. And then when the merger actually happens, you have the right as like a retail investor, you have the right to redeem your share at $10 if you do not like the merger. With the case of Grindr, what happened was 99, 98 something percent of the people who were holding the shares of that SPAC that merged with Grindr, they chose to redeem because they didn't like the deal. And it makes sense why they didn't like the deal, because they valued the company at $2 billion, which is way too much for a company like Grindr. To put that in perspective, Bumble, which is way more popular, which is probably like the number one, number two go-to destination for for like 20, 30, for people who want to date. That entire company that has a way more bigger market audience, I would say, that whole company is valued at $6 billion. Look at Match Group. The Match Group has so many dating sites. They have Tinder, they got Hinge, they have their whole Match.com. They own a bunch of other companies as well. That entire group is valued something around $10 to $12 billion, something in that range. I don't know the exact number. Anyway, and then comes Grindr. Sure, 2 billion sounds less than 6 and $12 billion, but the thing with getting valued at $2 billion is they kind of don't deserve that valuation, because the market for Grindr is a lot smaller than Bumble or Hinge or Tinder. So anyway, people don't like the deal. They redeem their shares. The money that the SPAC had, let's say the SPAC had 150 million, that 150 million kind of disappears. To combat that, what companies do is, while they are de-SPACing, while they're merging with the SPAC, what they do is they look for PIPE investors. PIPE investors stands for Private Investment in Public Equity, PIPE. These are basically investors that kind of guarantee that, hey, we will give Grindr at least $20 million if this deal goes through, and we will be buying the shares at, let's say, $6. Nowadays, it's more complicated. Nowadays, you have convertible notes, you have convertible debt, bunch of different fancy structures that are coming out, I would say. But anyway, to answer one part of the question, the companies look for PIPE investors, and your investment bankers, your whoever is the M&A advisor, these are the kind of people who help bring these PIPE investors. So any one of us could be PIPE investor if we have a lot of money, essentially. If you have 20 million lying around, you want to buy shares in Grindr at $5, sure, that's a possibility. In fact, you can get a better deal nowadays just because the market's bad. Back in 2020 or 21, PIPE investors were buying in at like $8 or $9, but nowadays it's better. I think another example is DVAC, the Truth Social, the Trump's thing that's going public. I believe the PIPE investor over there bought in at $34, which was amazing that they were able to get such a deal. Because amazing for Truth Social. I'm not amazing for the PIPE investors. Truth Social, like they were somehow able to sell their shares at $34 to bigger, richer people somehow. I don't know how that worked out. But yeah, to essentially answer, I think I covered everything. So redemptions are high when people don't like the merger. So what happens when the redemption is high is that the float of the float of that company, float translates into the number of shares that are actually in the market. That number of shares get reduced. Let's say you had 10 million shares, 99% gets redeemed. So you're down to just 1% of 10 million left. Those, which is 100,000. Now you only have 100,000. Not every 100,000 share is going to be traded every day. Maybe only 5% of those people are actually trading or selling their share. So only 5,000 shares essentially are available on the market. And when people look at, let's say some other guy looks at, they're like, Grindr is going public. I use it every day. So let me buy some shares of Grindr. When they try to do that, what happens is it takes away from that 5,000 available shares. The price really shoots up. And then when it's at $70, people are, oh, let me just sell it. And that's what happens. And then the share kind of goes down very quick. It also goes up very quick because there's just not enough available. So yeah, that's essentially what's happening. Yeah.
Hold on for a second. We've got a couple of questions over here.
Hey, Praneet.
Yeah.
I'm wondering, looking at the market in India of tech or other companies, if you've noticed a concentration or things you might want to invest in or look at. I've just never invested there. I've never been there, but I'd like to.
For India, the best. So India has a lot of mature companies. Mature companies meaning they have been around for 150 or 100 years. One of the companies that we're dealing with, it's well, let's record it. So without going in specifics, it's a 130-year-old food manufacturing company. And it's a very stable company, I would say. They don't have crazy high profits. They are just doing fine, and they have no issue coming up in any time next 5 or 10, 20 years. So India has a lot of those companies, but if you want to invest in something that's like the next upcoming kind of stuff, tech would be good, I think. And I say tech would, not like the retail kind of tech, more like the B2B kind of tech. Retail tech would be like another Tesla coming out of India or something, or another, I don't know, another Facebook kind of platform coming out of India. You don't, not stuff like that, because it's too difficult of a space to be competing in. But B2B, so one of the companies, another company that we have, they're kind of making, it's a private company, and to put it simply, it's like the SpaceX for India, essentially. They're making their own rockets, and it's all private rounds. That company, like, they can push the same thing to other countries as well. So maybe that space would be good. Yeah.
Well, next question here.
Yeah, that's a great answer. and the clean space, and I think another emerging area is quantum. So there's a lot of stuff happening in that space. So, is there? So my question related to SPAC is, is there a company out there that did SPAC right, and currently, before and now? Because my question is really related towards, should I even invest in these kind of vehicles, right? Because if everything is really done incorrectly and then eventually it'll get regulated, then is that anything I should be looking at?
So the only time you should be investing in a SPAC, I would say, is when the deal is fairly valued. And how do you know a deal is fairly valued? Is you look at the competitors, and if the competitor is trading at 5x of the revenue, whatever you're investing in should not be at 5x, should be maybe 3x or 4x. There should be some discount given to it. Those are the SPACs that would be good to invest. But then you also got to put in consideration the whole market sentiment right now. The whole market sentiment towards the SPAC right now is kind of pretty bad, and the redemption rates are very high. So once you look at the valuation, the next thing I think should be to look at the sentiment towards that company, towards the, look at what kind of redemption rates were there, look at maybe just wait a little bit, maybe the float is too tiny, which means these SPACs definitely gonna fall. So maybe you can pick it up at even better valuation down the line. It's kind of like, SPACs are kind of like accelerated series round, I would say, that essentially puts them on the market as well. Touching on the quantum aspect for India, I'm personally not aware of too many, I'm not too familiar with the quantum space to begin with. It's not my forte or my niche, but India, I'm sure kids from IIT Bombay or IIT Delhi, Indian Institute of Technologies, I'm sure some kids out there will be doing something with quantum space. And quantum, I feel like, just a personal opinion, I feel like it's more B2B to start off with. Once you prove more application in B2B, maybe then you can go to retail. I don't see quantum coming to your Apple iPhone in next 5-10 years. I don't think is going to happen, but eventually down the line.
It's already example. It's not happening.
Oh, wow. It really is.
Yeah.
Oh, wow.
They came out May this year. They clocked them a random number of generations.
Oh, wow. Okay, so there we go. But things will take some time to pick up, essentially. And yeah, so that essentially is the answer.
In case those in the on Zoom didn't hear, what Nardo said was that the quantum chips are already in some of the Samsung iPhones or smartphones. And so it is technology that's already being utilized. And we had a couple of interesting questions, so I wanted to maybe expand on that a little bit. Now, the question with regards to the redemption and flows, just to put that into perspective for those that are not that familiar with those concepts, to use a more simpler explanation, supply and demand. So if there's a strong demand and a low amount of supply, you have what's called inflation. And so we see that right now it's happening, with our high inflation rate, high demand, low supply. So with the small float percentage, if there's a high demand, that will help drive up the price.
Yeah.
Unfortunately, that price gets driven up quickly because of the stronger demand versus supply. But the redemption, now the float, that means that if the company starts selling more than what that float is, that then quickly drops the price or share value. Is that correct?
Yeah.
Because now you have a large amount of supply, but maybe not as much demand. And so the result, price is going to drop.
Yeah, essentially, it's a very high demand and the float is low, which means there's not enough shares available to buy to begin with. And when a lot of people start buying these things, and there's like literally 5,000 shares, or maybe 10,000, 15,000 shares available. And there's a lot of people out there. Someone buys 100 shares and then someone buys in at, let's say, $15. Price goes all the way to $70, as with the case of Grindr. Goes to $70. Someone who bought in at, let's say, 25 will see, oh, it's at 75. Let me just sell it the same day. They sell it, and then it kind of starts falling from there. So, yeah, that's fairly put. Yeah.
Okay. And then also to put things in perspective as far as 2020 and 2021, the reason why SPACs were so popular, would you say it was because of the low interest rate during that time period, in addition to the trillions of dollars that the stimulus spending that the government put into the economy because of the pandemic and trying to stimulate the economy, or at least keep the economy healthy? And now with all of that money, investors are looking for a higher return. Obviously, if you put it in anything that is CD related or related, they're not going to get much return with such a low interest rate at that time. And so now they're looking at riskier investments, equities, such as stocks and SPACs and things like that.
Yeah, so 2020 and 2021 were very interesting because during the same time, some of my friends and I, we were able to raise Crescent Fund, which is a student-run venture capital fund that exclusively invests in other student-run startups. So my friends and I started that, and we fundraised $1 million for that. And this was all during 2020, early 21, some part. And there's just, there was too much money available in the economy. I do agree with you. And if kids can do it in their junior, senior year of college, and then there are bigger players out there. There's Chamath, there's Bill Ackman. These guys could get a lot of money easily. So Bill Ackman came out with his SPAC, which had, I believe, $2 billion in it. And his entire purpose was that he's going to find a very big company. If you have $2 billion and you have to put it in one company, that company's valuation would at least be at $4 billion, assuming you buy half of that company. So the valuation will be $4 billion. And we don't have that many private companies that can really command that kind of valuation. So someone like Bill Ackman, who has all the resources, all the connections, he also could not find a target that could satisfy that valuation, at least $4 billion kind of valuation. It would realistically be more around $7 to $8 billion valuation. So if he couldn't do it, sure, there's money available out there, but he couldn't do it. Then there's Chamath. He kind of did it, but then he really talked up a lot of his companies, and then the shares obviously fell down. Most of his stuff is trading $6, $7 something dollar, and then a couple of his SPACs are now getting liquidated because he just does not have targets. And these are big guys. They have all the connections. They got a lot more resources than I do. They couldn't close the deal just because America would not have sufficient number of targets. But I propose look outside of America. There's India, and we checked the legalities and the accountants with the accountants, and it's doable. It's not impossible. Last year there was a SPAC, RNW, Renew Power. It's an India-based company. They actually merged with an American-based SPAC, and they're listed on the American market. So it's completely legally possible. So yeah, maybe SPAC people need to switch their gears, see outside of America, and yeah.
You bring up an interesting point about the opportunities to bring companies in India to the U.S. market. And you maybe talk about this in a little bit, but the question is kind of two parts. One, the Indian capital markets is not as efficient as the U.S. market. So there's probably a lot more of these larger, well-established companies that are not publicly traded just because of the fact that the capital market is not as efficient as the U.S. market. So that presents, obviously, an opportunity. Second is that, and this relates to a question that was asked earlier about investing in Indian companies, is that India is projected to be the fastest growing economy, I think, in the next 10 years. It's faster than, growth-wise than the U.S., China, Japan, even the U.K. And so obviously when you have an economy that's growing, the companies there that are based there are going to benefit from that. So can you talk about those two? One, the capital markets, and two, the economy in India and what that looks like?
Yeah, certainly. So touching on the first thing, the capital markets in India, they're not as developed as America, I would say. So I talked to a couple investment bankers in India, and Indian investment banking is very different from American investment banking. In India, investment banking, they might not necessarily have the clients who can really put in money into whatever product they're offering. Whereas in America, the investment bankers do have a good number of clients. They have a lot of backing behind them, and they're able to fund deals like TMC, or deals like TMC was a stupid deal. It got listed at like $1 billion valuation. They have no revenue to begin with, and it's kind of like someone just woke up and they're like, oh, I'm going to put my company at $2 billion valuation on market, and I have 20 million to do that. So it's stupid. Anyway, so India, coming back to Indian capital markets, no, it's not that developed. I had another chemical company from India, $85 million revenue. They have about 185 million in assets, about 10 something million in liabilities, and cash flow positive company. It's a good company overall, but they could not list on the Indian market just because the investment bankers from India just couldn't find them investors that could give them a good valuation and really put them on the market. So didn't go through. So yeah, and then the economy in India, I think the reason India is like one of the fastest growing economies because people, honestly, we have like 1.4 billion people out there. That's like what, like 1 in 6 something people that you see is probably Indian. I'm Indian here. So, and like, look at San Jose or Bay Area, like almost every other person over there is Indian. I think it's mainly to do with the fact that there's a lot of people. When you have a lot of people and good infrastructure, good infrastructure is debatable. For some people, this kind of infrastructure is good, and for some people, this kind of infrastructure is good. What I mean to say is, like, to put it in perspective, like we have tuk-tuk, auto rickshaws in India, like they will take you anywhere and it's so cheap. And that's amazing. I think that's only possible when you have a lot of people. And another good thing about India is that for every price range, stuff is available. You want to get a $5 coffee in India, which is 400 rupee. Sure, you can go to Starbucks. You want 10, 20 cent coffee. Sure, that's possible. You go to some corner store or something. So things are cheap in India, and there's something available in every price range. And I think there's a lot of factors. I can't cover everything, but all those things kind of contribute to how the Indian economy is doing well. I believe our stock market, the Indian stock market, was only down 2 or 3%, whereas the American one's down 20-something% for this year. Yeah, there's a lot of factors, but yeah, to answer, yeah.
So just to help you out a little bit on that,
Yeah.
and then I'll share with you what I read or heard is
Yeah.
that for the Indian population is like 1.4 billion.
Yeah.
Might soon exceed China, which is right now the most populous country in the world. But one advantage is that the average age is much younger, which means we have a much larger workforce.
Mm-hmm.
And for the economy to grow, you need employees or workers. And that is one of the reasons why I've heard that as far as the rosy projections for the Indian economy is because of the workforce and also the talent, the so-called educated population. And you mentioned Silicon Valley and the number of engineers there that are highly educated, which attribute the economy's rosy outlook to some of those factors.
Yeah, people are very educated in India. I would definitely agree with you on that. Like all kinds of people, they have that dedication, motivation kind of thing going on with them. They're like, oh, I'm really going to study hard, going to become whatever pays the best. So 20 years ago when I was like a little kid, like back then the trend was to become a civil engineer because back then that's what used to pay the most. Nowadays, the trend is to become a computer science engineer. And no matter, like I'm now looking at my friends from middle school who were not even interested in computer science. Now they're all computer science engineers. And people kind of pick the major based on what pays the most in India. So that definitely contributes to being the most educated. Once you have the CS skills, you maybe one day something shines on your head and you're like, oh, maybe I should build a tool like this. And who knows, maybe that tool makes a lot of money for you, brings in a lot of revenue for India from outside. So stuff like that, yeah, certainly happening. And I believe there's a state in South India, and they have like 99% literacy rate, something like that. Kerala, that's the state's name, 99 or 95, something 90% literacy rate. So definitely a lot of educated population here. Yeah.
I'm going to wrap things up unless we have more questions. No more? Okay. Well, yeah, as far as the literacy rate and the workforce and all that, I think that the other projection that I've read that I find very interesting is that India, which is I think right now ranked number 5 as far as the world GDP is concerned, is going to soon surpass Germany. And when you think about Germany, you think of companies like BMW, Mercedes, and other large conglomerates or large corporations. And it's interesting now that you have a company in India. Now, I'll be honest, I can't think of a large Indian company off the top of my head. Yeah. But that are well-known household names.
Jaguar. Yeah, I was thinking that. Yeah, those are owned by an Indian guy, and the Tata, Birla, Ambani. Those are like the famous families from India, and they own pretty much everything out there, at least in India. But like even outside of India, there's Taj hotels. I don't know if you've heard about them, but Taj hotels, they're in America as well, and these are like 4 or 5-star hotels. They're all owned by the Indian guys. And I think I read somewhere a couple of weeks ago that most of the motels in America are owned by the Patel community of India, something like that. And then it's like London's 60 or something % of real estate is owned by Indian people, and that's in London. So I think having too much population is definitely helpful, because then you can send your people everywhere and they make money, and then they buy the real estate there, and then they eventually kind of sometimes bring it back to India. So yeah, maybe all that is contributing for sure. Yeah, and one of the good things about India is that labor is cheap, and you can get one of my friends who recently graduated from IIT, Indian Institute of Technology in India. She's a computer science major. She got a job at Google, and she's making about $50,000, and that's in India, and that's at Google. So that's kind of like the peak pay for a computer science engineer. So at 50,000, Google is able to get a really good computer science programmer. If you go freelance, you can maybe get one for $25,000-$30,000 range of full stack good CS developer in India. So labor is cheap. So if you want to like build something, develop something, you can pretty much outsource your entire engineering team to India. And there are people like that in America whose full-time job is to essentially outsource stuff to India. A couple of people I know, they made a lot of money doing that essentially. But yeah, that's the whole picture of India and everything.
All right. Please thank Praneet for this wonderful discussion. Thank you to all of you.
Thank you. Thank you for having me. Yeah.
I do want to take a minute to thank the Friday Coffee Meetup volunteers. It has been a lot the last year to come back to in-person. We have Doreen here. We have John, our resident Socrates. We have Evan. Normally we have Toby and Wayne as well, and Jan. We also want to thank Echo Factory, Innovate Pasadena, Founder Space. But first off, can we have a round of applause, please, for our Friday Coffee Meetup volunteers? So thank you again to Founder Space for generously hosting us in this beautiful space. We thank Wilson Francini for the coffee today, and Rosten Capital for providing it to us. With that, we're going to wrap up. We're going to have Praneet come here. If you all can come into the center, we're going to get a photo of him for our social media.